This is a real crisis. I mean, we've seen regional bank failures. That's just the start of it. The real trouble is yet ahead of us.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 29th through May 6th, 2024, while supplies last. First, we feature 2023 1-ounce South African Silver Krugerrand at just $3.10 over spot. Next, backdated 1-ounce gold Australian Kangaroos are only $59 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always delighted to have this distinguished returning guest, Alasdair Macleod, the head of research at goldmoney.com and also a former bank director and the founder of Macleod Finance, joins us this Tuesday, April 30th, 2024. Alasdair, thank you for joining us on Liberty and Finance.
That's my pleasure, DK.
I was reading with great interest one of your recent articles on your Substack about whether the pullback we are seeing for the past week or so in gold and silver signifies a exhaustion of the bull phase that had been going on for about a month in both of those metals and, frankly, the miners as well. If you could take us up close to your research and the historical bases with which you're comparing things and the contrast you're making there, to let us know whether you think the current rally or the recent rally is in fact exhausted, or are we just doing a consolidation as is normal in bull markets?
Well, it looks like a consolidation, but this is different from anything we've seen since the 1970s. And of course, most of the people who see this video won't have experienced the 1970s. Now, what I mean by that is that we have seen bond yields rise, which in recent years, recent decades, has been bad for gold. We've seen the dollar rise on trade weighted, which has been bad for gold. And taking particularly those two together, you would think that gold actually would have fallen. But instead, it rose as bond yields rose, and it also rose as the dollar rose. So this is a very, very different time, I think, from anything we have seen since those 1970s. Now, principally, the difference between that sort of period following the 1970s and the 1970s was until interest rates were raised to close to 20% by Paul Volcker, there was a fear in the markets that hyperinflation would take place. In other words, the purchasing power of the dollar and other currencies would decline substantially in this new, it was then a new sort of fiat paradigm, if you like. That was finally broken by the determination of Paul Volcker, as I just said, by raising interest rates. Now, since then, interest rates and bond yields have declined and declined and declined. They've now started rising. The problem with rising interest rates now is that it exposes government debt, it exposes malinvestments, it exposes a lot that's going to go wrong in the world of credit. And principally, when it comes to monetary affairs, there are two worlds. There's the world of money, which legally is gold, and there is all the rest, which is credit. So it's that relationship between gold and credit. So what the gold price has been telling us in recent months is that the fear is now about the future of credit, not interest rates, not the exchange rate of the dollar measured in other fiat currencies, which of course is what the trade weighted index is. So this is fundamentally different. Now, to an extent, it has been led by China. The pace of Chinese buying, not just the central bank, but also other Chinese actors of physical gold, has increased. And indeed, we have seen this extraordinary situation whereby Western ETFs have been declining and feeding gold out, as it were, into Asia. Now, this is an extraordinary situation because what that again tells us is that we in the West have tended to sell gold while it has been going into new high ground. Now, this is the sort of behavior which is temporary because there does come a point, I'm just purely talking about psychology now, there does come a point where people sort of turn around and say, well, hold on a minute, gold is in a bull market, bonds are in a bear market, that makes equities less attractive. The only game in town is gold. Therefore, we should, why is it going up? Perhaps we should buy it, sort of thing. So it's a sort of in-between period, if you like, in terms of the psychology of markets in the West. The fascinating thing about it, however, is what are the Chinese actually doing? And if you look at it from the Chinese central bank's point of view, the People's Bank of China, they have a long-term policy of reducing their dependence on Western currencies. This, after all, was the whole point about trying to set up a new trade settlement currency for BRICS, which was mooted before the Johannesburg meeting in last August. It is also a vowed public policy of the Chinese government, the Saudis now, Russia, Iran, the Shanghai Cooperation Organization, and the extended BRICS organization as well. So what we're looking at is a situation where the two major hegemons, particularly Russia, who's, with Putin had his nose put out of joint by sanctions, currency sanctions, and China, they basically want to do away or lessen their dependence on the dollar. So from the People's Bank's point of view, it would be entirely consistent for them to reduce their holdings in dollars. Now, when you look at that properly, really, it's not so much that they're buying gold, but it's more that they're selling dollars. Now, this adds, and I think that this is something which markets will begin to realize quite quickly, it adds another dimension to the dollar problem. And that is that the largest single identifiable buyer of US Treasuries is the Chinese government. And the Chinese government is selling dollars. And if it's selling dollars, it's also selling the underlying assets in which those dollars are invested, which, of course, includes a figure like $775 billion worth of US Treasury debt. So if the Chinese are actually reducing their dollar holdings, then what that means is that they are not going to be participating in the increased financing requirements of the US Treasury with a budget deficit of over $3 trillion to fund. This is going to create a debt crisis for the US Treasury. So that message, I think, is gradually spreading in the higher echelons around Asia, particularly China, Russia. Russia, I think, can't wait, basically, to crash the whole thing. The only reason they don't do that is because of their relationship with China. But China can see that things are changing. They have got to change. I mean, the problem for China is that they really have no alternative but now to just quietly ease themselves out of dollars. And that is what they're doing. And of course, the other thing, there is increased speculation on the Shanghai Futures Exchange, which is one of the things that has certainly contributed to the rise in the value of gold measured in dollars. Now, that speculation, I think, is probably informed by an analysis of actually what the People's Bank is doing. So that speculation, I think, is likely to build up. Now, futures markets don't necessarily lead to demand for physical, but there is a requirement for physical if you get increased open positions in that market. And those open positions will be reflected two ways. Firstly, in terms of the collateral that's required to back those positions. And the second thing, and the collateral really will be in the banking system, as it were. The second thing is that there is probably, through Globex, Chinese involvement dealing on COMEX, which again basically means that the swaps on COMEX will find it extremely difficult to close their positions. So the reverberations of what China is doing, the position that China now finds itself in, are going all the way around the world. And despite the fact that retail interest in America and also in Europe is declining on higher prices, prices are still going to rise. As to this recent reaction, I would say that it is perfectly normal. The excessive speculation, perhaps, which is reflected on the Shanghai Futures Exchange, might be behind this move back. There has been a build-up, if you like, in terms of open interest on COMEX as well. Not excessively so, but taking the managed money portion, if you like, or category, to just slightly more than average levels, if you like. Now, that does imply that if you get just a loss of short-term momentum, then these guys are vulnerable to having stops taken out and encouraged to sell on, because there's a correction. And I mean, they're in there, the business of buy dollars, sell gold, or the other way around. Now, they've been screwed by that relationship actually not working, because both the dollar has risen and also the gold price has risen. So they must be somewhat confused. But if you are in that position as a hedge fund manager, what do you do under these circumstances? You basically back out until you feel more confident about which way this is going. So I think that probably describes where we are in this consolidation phase after this very sharp run, having broken out of a 2.5 year, nearly 3 year consolidation. Or is it 4 years? Almost 4 year consolidation. I mean, it's the sort of major move on a breakout that you would expect to see. So this pause it doesn't reflect the end of the move. It reflects, if you like, gold is gathering up her skirts before she makes her next move upwards. And I think that's the best way to look at it. If you're a trader, then you put, your life is in your own hands. Don't ask people like me or you what the hell to do. If you have to ask that sort of question, you shouldn't be playing it. But if you're a stacker, then the answer basically is just keep stacking. If you observe what is going on in terms of the undoubted debt trap that is being sprung on the US government and other governments, incidentally, US government's got something like 125, 130% debt to GDP. That was fine when, we were at the zero bound, but now we have not only got interest rates rising. You look at the yield chart for the 10-year Treasury, and, if you actually bought the yield or were looking to buy the yield, you think, gosh, this is looking very, very good. Yields are going higher. If you're at the Fed, you're sitting there thinking, we want to promise lower interest rates, but we can't do it. And that actually describes pretty well the position which the Fed finds itself in now. And increasingly, market participants are looking at this and beginning to realize that interest rates might not come down. And many of them, or an increasing number of them, actually beginning to understand that interest rates have got to rise. Why? It's not because of inflation. Well, inflation, you can see that, month per month, the CPI-U has been ticking up from last October. I think I'm right in saying that March was the same as February. But other than that, every successive month has been higher and higher and higher and higher. Forget that, the 1 year moving average. Just look at that, over the last 6 months, what's been happening. So inflation is going up. But the real crisis isn't so much inflation. It is the debt trap that the US government has got itself in. It is then the question as to how high bond yields have got to go for the US government to fund its debt. And there is a further question on that, and that is the higher these rates go, Does it make that debt more attractive to fund, rather like the situation that Volcker sorted out when debt to GDP, incidentally, was something in the order of about 30%? Or is this a situation where higher rates actually make the debt even less attractive? It's beginning to look like the latter. And the more people begin to understand this, the more the flight out of credit will gather. And that flight will go into gold, because gold is the legal form of money. Not only is it the legal form of money, but it has no counterparty risk. You don't want to be in anything where there is counterparty risk. And unfortunately, the consequences for the private sector economy are equally appalling. There has been so much malinvestment. It is the result of suppressed interest rates, suppressed down to the zero bound for a prolonged period of time. And, businesses have been borrowing credit off the banks, funding it, sort of short term. By short term, I mean up to 2 years sort of thing. Not because they were deploying it productively, but because the opportunity to get this, to get credit in order to speculate in something is just too attractive to miss. Now that we've gone from 0 to 5, and it looks like the yield curve will actually go positive, this is a real crisis. I mean, we've seen regional bank failures. That's just the start of it. The real trouble is yet ahead of us, and how we navigate our way through that is at this moment extremely difficult to see. But coming back to the relationship between gold and debt, it is extraordinary, and we have not done this since the 1970s. It is extraordinary to this generation, if you like, of investors to see bond yields rising, the dollar rising, and gold rising all at the same time. And I think I have just told you the message as to why that relationship is back in place, having last been seen in the 1970s.
That's a very key point, because so many of the retail financial advisors and personal financial advisors that people have are students of the last 20, 30, even 40 years, where we've had this regime of falling interest rates and the bubble of everything, stocks, bonds, and real estate always going up, and you buy on the dips, and that's, you ride things out, you get 7% or better year over year on average, etc. But this new tidal sea change that you talked about that takes us back over 50 years is eye-opening. A couple of key things I wanted to zero in on that you brought up along the way there was the gold holdings of China, their propensity for amassing gold, and also their strategic, diligent efforts to divest themselves of the US dollar and US Treasuries. Could you maybe take those one at a time? Because there have been several analysts in the recent months who have said, well, after all, the U.S. has the largest claimed holdings of gold of the world, and it always rubs me the wrong way when I hear that, because I've heard some parts of your analysis of what you suspect might be the less publicly admitted story of gold holdings in China. Can you maybe take us first close in on that, and then we'll talk about China's program of divestiture of U.S. Treasuries, et cetera?
Yeah, absolutely. I mean, we go back to 1983 when the Communist Party introduced legislation appointing the People's Bank of China as being responsible for managing the acquisition of the nation's gold and silver stocks, reserves, whatever you like to call it. You may recall that from 1983, I mean, we were literally a year or two into the greatest bear market gold has ever seen. A bear market that came about because America had an intense propaganda campaign demonetizing gold and replacing it with the dollar in terms of everybody's reserves. So it was a process which worked very, very effectively, and it shook out an awful lot of physical gold. over that period, there was also there were innovations in mining, which meant that mine output increased quite significantly. Globally, this is. And so you had a combination of hoarded gold and mine supply coming out on the market. And it was an easy environment for China to accumulate gold reserves. Remember also that when this legislation came in place, it was perfectly normal to think in terms of national reserves, if you like, as being 10% gold and the rest, currency, credit, whatever. So the 10% gold, if you like, was a sort of portfolio allocation, which, was like an insurance policy against all the rest. I ran the numbers through. Now, basically, the other thing that the People's Bank was doing, and you've got to remember that there were huge restrictions on what individuals could do. There were very strict exchange controls, for example, and the public were not permitted to acquire gold and silver themselves. Holding gold was illegal until 2002. So all the foreign exchange dealings, when you had inward investment as China opened up its economy to manufacturing, and then subsequently the continuation of those flows, and at the same time, the export trade was beginning to boom in, really from the early 1990s, right, or 93, 94. It really began to boom from then. If you looked at those flows and calculated the reinvestment of those flows into contemporary gold prices, which you may recall fell to as low as $250 an ounce in 1999 and I think 2002, it was easy for China to accumulate substantial quantities of gold without really the rest of the world noticing, particularly with the world's attention taken away from gold, because it was, as far as the Americans were concerned, relegated to the status of a pet rock. So you could see that this was a very good opportunity for the Chinese, who never bought into this sort of fiat Keynesian paradigm, as it were, concept of a fiat currency. They never bought into that at all. But they did understand, they still understand, that gold is money and the rest is credit. I calculated that by 2002, when quite clearly the People's Bank took the view that the state had acquired enough gold. By then, incidentally, I think the official holdings were in the order of 600 tons. I mean, peanuts, really. But clearly, the Chinese government, authorities, and the People's Bank decided that they had accumulated enough of a gold reserve, which was sort of distributed around various accounts, like the People's Liberation Army, the youth wing of the Communist Party, and so on and so forth, not reflected in the People's Bank's reserves. This is the important case, the important point. So by 2002, clearly having the state got its position to its satisfaction, it then opened up the market, the gold and silver market, to the Chinese public. And the Chinese public were actually encouraged by the Chinese authorities to use the newly set up Shanghai Gold Exchange to acquire gold as part of their own wealth. The television adverts and all the rest of it were this was. But the thing that's interesting about the timing of that was that the timing of these Chinese advertisements telling their citizens to accumulate gold was basically around about the time when we had the great financial crisis developing, which ended up with Lehman, going bust and all the rest of it. So obviously, you could see that the psychology, if you like, of the Chinese leadership, looking at what was going on in the dollar and thinking, hold on a minute, this is not good for our citizens. they were encouraging Chinese citizens to go out and buy gold. So, interesting point about the timing of that. Now, I think that by that 2002 date, just looking at those flows, the capital flows in, the export surpluses going out, I reckon that at contemporary prices, the People's Bank could easily have accumulated up to 20,000 tons of gold. And at the time, I think the People's Bank said it had something like 610 tons. That was it. The rest is secret. We have a similar situation in Russia. Russia lost all her gold, basically, before Putin came in. And since then, certainly the policy has changed. Russia has gone very anti-Western currencies. Very notably since sanctions, SWIFT was closed down to it and sanctions were imposed. And effectively, the West is stealing the credit reserves on the central bank's balance sheet. And that's subject still for today. But at the same time, Russia has been ramping up her gold production. She now produces over 300 tons a year. And I think she may just be third to Australia, but if it is, it's sort of level pegging, with plans to increase even further. I think one of the reasons that Russia has been concentrating on capturing politically the Sahel, which is that bit, if you like, between North Africa and the tropical Africa. Countries like Burkina Faso, Chad, Equatoria, Mali, and so on and so forth. Those are gold-rich areas. And I think that that's something which Russia rather wants to get under her control. The successors to the Wagner Corps, mercenaries, have been working on that on Russia's behalf. Russia also has two sovereign wealth funds, one of which is designated as a precious metals fund. The other one, I think, if I remember correctly, is called a Gold Fund. Sources who I would say are, I've found to be normally pretty reliable, tell me that taken together with Russia's 2,200 tons of official reserves, Russia has probably got a total of about 12,000 tons of gold at its disposal. Now, you mentioned the situation with America. America has 8,133 tons. But the question is it there? The question becomes really a very important one when you bear in mind that Germany had great difficulty getting just a small portion of her gold back from the New York Fed. And this is gold which is earmarked. Now, what in the terminology earmarked basically means held in custody. It's the central bank language, if you like, for custodial gold. The other thing is that we do see every time when Libya fell, for example, when you had the color revolution back in 2014 in Ukraine, allegedly, the first thing that happens is the Black Hawk helicopters come flying in and guys in, Navy SEALs or whatever they are, nip out, grab all the gold out of the central bank of the nation which has just been destabilized, and they fly off with it. So, why is this appetite for gold? Bear in mind also that a very respected analyst, Frank Veneroso, did some groundbreaking research into central bank gold back in the 1990s. And he stood up at a conference in Lima and said that he concluded that up to somewhere between 10 and 14,000 tons of central bank gold had been leased or swapped, much of it adorning the necks and wrists of Asian women. In other words, the gold had gone and, gone from the central bank system full stop. So what's happened to that? 14,000 tons, the higher estimate or at the higher level of his estimates, was precisely half the total 28,000 tons of central bank gold recorded by the IMF at that time. So if up to half of it was out, where was it out from? Was it out from the Bank of England? I don't think so. The Bank of England has been doing a lot of leasing over the years, but the way that tends to work is, and certainly latterly, I mean, I don't know, I can't go back too much, but certainly latterly it's a book entry. You know, you've got the chap, if you like, in the in the vault saying, you know, and this bank has got so many tons, this bank has got so many tons. Okay, this bank is leasing some gold to someone else. Right, it's not leaving the vault, but there's a new entry in the ledger, if you see what I mean. So I think certainly in the last 20 years, this disappearance of gold out of the Bank of England's vaults is probably not an issue. But that leaves America. And I think that this explains why it is that Germany had such difficulty repatriating a small part of her gold. I think it also explains why, allegedly, Black Hawk helicopters are the first to arrive once a government has been toppled. They clean out the central bank's gold. The gold that has been leased, that 14,000 tons, 10 to 14,000 tons, whatever is still out there on lease, has probably predominantly gone out of US hands, if you like. And that would also make sense because it is the US government which has led the way in trashing gold as money and tried to replace its role as money with the dollar. It has been on a propaganda come suppression, gold price suppression campaign, really ever since 1981. So that I think, I think that's the way to look at this relationship between how much gold America has actually got, which I think is questioned, because we're not only looking at those 8,100 and something tons, we're also looking at earmarked gold, which she would have to provide out of her own stocks if she was to honor the property rights of foreign central banks who have stored gold with the New York Fed. And against that, there is absolutely no doubt that there have been substantial acquisition programs by China over a long period of time. And still, ever since 2002, we have seen the Chinese public has accumulated something like 24,000 tons of gold. This is on top of anything that the state has got hidden round those various accounts which I just described. I mean, that's, and still we see that China has, I mean, she's confirmed this policy in effect by investing as a priority in her mine output. She very quickly became the largest miner by gold output in the world, overtaking South Africa, which was admittedly declining at that stage. On top of that, we know that gold has been migrating from us to China, and it never gets out of China. I mean, a little bit comes out maybe in the form of jewelry, but no, it basically is Hotel California for gold. And I think that this has got the makings of an absolute crisis for the West. It clearly signals the Chinese authorities' approach to the dollar. They know it's going down. They have still got 770 billion of US Treasuries on their books. And that is not incidentally on the books of pension funds and insurance companies in China and so on and so forth, like it is in Japan. Japan is now recorded as the largest holder of US Treasury debt, but that debt is not held by the Bank of Japan. I was looking at this the other day, and the Bank of Japan has in the region of something like $60 to $70 billion worth of that debt. The rest is owned by pension funds, insurance companies, banks, whatever, who, out of their negative interest rates until very recently, and it's still zero interest rates in effect, have been creating credit in order to buy US T-bills. A lot of the US government's financing is coming from that sort of source. But the largest single identifiable holder is the Chinese government. And the reason I believe that Janet Yellen has made 2 trips to China in the last year, including one very recently, and US Treasury officials have been going over there talking to the Chinese, is they understand that the largest single holder of their debt is the Chinese government, and they have to persuade the Chinese government not to sell any more, and preferably to return to the market as a further buyer, because America is running a budget deficit in excess of $3 trillion, and you've got rising interest rates, which are going to make that worse. Because remember, that debt all rolls up. The interest rolls up. You're not paying it. You have last year the figure was, I think it was a bit over $1 trillion or something. This year, I think this year it's going to be like $1.5 trillion. That isn't paid. That's just rolled up into next year's debt requirement. So that's where we are, I think, as far as the gold position, US relative to the Asian hegemons is concerned.
I really appreciate that depth first tour of the situation as you've seen it, as you have analyzed it. But I wanted to point out one thing along the way that reminded me when you were talking about China not officially acknowledging the actual accumulation of their gold. From Sun Tzu's Art of War, it says to appear weak where you are strong and strong where you are weak. So it seems that the U.S. may be playing on the one side of that and China on the other. Now, also you mentioned this program of strategic divestiture of treasuries and so on by China and Russia, and that they're both eager to wash their hands of this given the weaponization of the dollar in recent sanctions, etc. If the United States is so bent on trying to persuade the world to continue the good old days, how does that? Can you bring us into the present moment? The body language doesn't match then. If the lips are saying from the West, oh, please keep buying our debt, but the actions are doing everything it seems necessary to compel the rest of the world to dump U.S. debt. Where do you see that that's truly coming from, and where do you see it going?
Well, first of all, let me just correct one thing. In terms of the desire to topple the dollar, I think Russia has probably got more of a desire to do that because that's the easiest way it can win put an end to this Ukraine special operation thing, as they call it. But China, I don't think, that's not her style. She doesn't want to destabilize the situation, but she's been put into a position where she has to make a choice. Does she support a failing currency by buying more of it and a lot more of it? Or does she sort of quietly stand back and say, nice knowing you, but there's nothing I can do about this situation? And I think that's the emphasis I would make. Now, I think your point is an interesting one because we're getting very mixed messages. I mean, you've got Blinken telling the Chinese, you don't. If you make your technology available to the Russians, we will sanction you. We will do this. We will do that. And if you're thinking of going against Taiwan, don't. We will make your life so. There's all this sort of rhetoric going on. But I think you've got different departments in here. You've got, that's sort of foreign secretary type stuff. You've got Biden, who's probably asleep at the wheel, but, who cares? And then you've got the Treasury is an interesting one because the Treasury is making all the sort of noises about, don't subsidize your production because, you're putting our people out of work sort of thing. And then can you lend us some money? I think that's really where the mixed message is perhaps at its worst. I think the Chinese can accept this sort of foreign secretarial idea that that department has got its own agenda. It has got a political agenda which it's got to satisfy, just the same as Blinken's opposite number in China has got an agenda to satisfy. I think they understand that. But I think the mixed messages from the US Treasury probably a bit harder to explain away. But we're living in a world really where we've been condemning the central bankers. Central bankers are actually in a very difficult position. They can't actually persuade their political masters to do the right thing. Just put yourself in the position of Jay Powell and his relationship with Janet Yellen. I mean, this doesn't really come out in the open very much, but Jay Powell is sitting there. He has got a problem, and it's not helped by the fiscal laxity coming out of the Treasury. And okay, we can say it's an election year and, this always happens. Yeah, but hold on a minute. If Powell has no option but to raise interest rates in order to control the situation, then, you can talk about, sort of extra spending, political. It's actually immaterial. It's not helpful. It gives Powell a problem. So what does Powell do? Does he cave in? Everybody thinks he'll cave in. I don't think so. He doesn't want to go down as a very, very weak Fed chairman who gave in to the politicians. We hear that if Trump wins, the first thing he's going to do is sack Powell. That's a load of rubbish. You do not sack the chairman of the Fed, because you do that, you destabilize your currency. So, I'm afraid that if Mr. Trump wants to sack Powell, Powell actually is safe where he is. Powell has an enormous incentive to ensure that his historical legacy is not as a weak Fed president. And I think markets have got to understand that.
This is painfully amusing or terrifying, depending how you look at it. Anyway, we're just grateful for your insights here, and I can totally understand what you're talking about, the political reality of you've got this posturing between the foreign secretaries of the U.S. and China that have to do their saber rattling to keep political boats afloat, and meanwhile you've got the actual dilemmas being wrangled out and the reality of how things play out on the ground between the treasuries, etc. But there are intractable problems here. There's intractable strains. You call it a debt trap. The U.S. is in a debt trap. So no amount of posturing is going to undo that. That's a matter of mathematics and eventually natural consequences and willpower and austerity and all kinds of things that are going to play out. But it's been very helpful for you to illustrate to us how the adults in the room have been for decades taking seriously the necessity of acquiring intrinsically valuable assets with no counterparty risk, etc., to survive the coming turmoil, the coming change, the changing of the guard, the changing of the regime that is coming and is inescapable at this point. Alasdair, for people who want to keep informed of your latest writings, you have a Substack channel. Where can they find you?
Yes, Substack channel is Macleod Finance Substack. Just Google it and you'll get there. I also act as head of research for Gold Money, so I write there. But basically, my writing is migrated to my Substack channel, and I would urge those of your viewers who haven't done so to subscribe. You can subscribe for free, but you'll only get the really interesting stuff if you're actually prepared to spend the equivalent of a couple of cups of Starbucks coffee maybe a month. It's that sort. It's not a lot of money, but I would hope that it would be the best investment that anyone could possibly make. And my mission is to educate and to make make sure people actually do understand what's going on with this very, very dangerous world.
I appreciate so much that you've shared that mission here with our subscribers and our viewers on Liberty and Finance. Folks, if you don't want to miss a single episode with Alasdair or any of our other guests that we interview on Liberty and Finance, make sure you sign up for our free newsletter by going to our website, libertyandfinance.com, put in your email address, click submit. You'll get a confirming email you need to confirm to opt in, and then you'll get every interview with Alasdair and our other guests emailed to your inbox, 1 email per day. We don't share your email address with anyone. And just make sure that you do that so that you don't miss a single thing. Alasdair, as always, on behalf of all of our viewers and subscribers, thank you for joining us here on Liberty and Finance.
That's very much my pleasure, DK.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 29th through May 6th, 2024, while supplies last. First, we feature 2023 1-ounce South African Silver Krugerrand at just $3.10 over spot. Next, backdated 1-ounce gold Australian Kangaroos are only $59 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.